heard a lot of stories about the wealthy moving to states with low or zero income taxes. But can that strategy work for the rest of us who are approaching retirement? Here's wealth manager Jeffrey Levine on the Decoding Retirement podcast.
Where I have seen in my experience, people base their decision solely or too heavily on where they're going to have the lowest income tax bill. At the end of the day, when you get to retirement, you've done all the hard work to get there, right? You've worked for the last 20, 30, 40 years, in many cases, even longer than that. The last thing you want is to go somewhere purely because it's going to save you a little bit in the way of taxes, but you're just not happy there.
Now, John, obviously your company's called Matthew James Tax and Wealth Management. I know you guys weigh these as part of the conversations. Can you give us examples where tax-based moves worked and maybe where they didn't for clients?
So, Chris, the thing is, we have to look at, number one, what type of assets are they reporting, or what's taxable, in other words. So we have to look at, do they have any brokerage accounts? How much money do they have in bank accounts that generate interest? What is their Social Security income if they're taking it yet? What is their pension income if they're receiving it yet? What amount of money do they have in qualified investments such as an IRA, a 401k, a 403b? Do they have any Roth accounts? Do they have any rental properties? Do they have any business interest? Are they receiving a K-1? Ideally, us looking at their tax return, the last couple of years of tax returns, and modeling what the current year would be in or future years, and looking at the reportable type of income that they could face. And then how can we restructure their assets? We can help someone that's in California, which is the most expensive state to live in.
Yeah.
Where on the top income brackets, you're paying state tax of 13.3%. That's a lot. So whenever you're looking at a marginal tax rate of 0.3%, that's expensive. Half your money is just going to federal and state taxes. So we have to look at how to neutralize your tax liability, how to restructure your assets. And that's the key thing, is we have to look at setting up maybe different entities, using some mitigation strategies depending on what type of income you're reporting. But if we're looking at strictly at your investments alone, and let's just not assume there's any real estate there's not a real estate portfolio associated with it. So we have to, or if you could, let's say if you had a real estate portfolio that was owned by your Roth, and yes, you can do that. A lot of people are not aware of that, where you can go self-direct and have your Roth IRA own an LLC, and the LLC owns rental properties. Now, ideally, you would have one LLC per address. That would be a smart way of doing things. And then from there is, we want to make sure we have the correct structure from an estate planning or legal level,
mm-hmm.
and then from a tax level. And so the key thing here is, if you're trying to reduce your tax liability, depending on what type of investments you have, assets you own, if you can take advantage of different parts of the tax code, and there's a lot of different areas of flexibility that we can utilize, that these strategies are very kosher with IRS. You can go, not that we want you to go through an audit, but people have gone through audits in the past using these different techniques, and they have received a no change letter from the IRS, which is technically your golden ticket. And so the thing is, we want to make sure that we're looking at all different angles, not just solving for one thing. So when I get into these detailed conversations with people, they might want us to focus on one thing, and I would ask them, what we need to do is we need to see your chart. Like if you go to a new physician, or referring, you've been referred to this other physician, before they even see you, the first thing they need to see is your medical chart.
Exactly.
Because they need to know exactly what's going on. Because if they try to fix a certain problem that you have, but they're unaware of the other potential issues that you may have, your blood work, blood type, all these different little things, they can actually do more harm than good. And the same thing with us. Whenever someone comes to us, we have to look at their complete picture of their taxable income, what kind of investments they have, what kind of business they own. So where if we implement something, we want to make sure that there's no negative cause and effect, in your scenario. And so what we look at is, if you have a tremendous amount of money in IRAs, we want to look at what is the most efficient way for us to move that money over to a Roth or a Roth alternative. And the key thing here is, whenever someone has a significant amount of IRA income, they're faced with required minimum distributions in the future, whenever they turn 73 or 75, depending on what or someone could be receiving them now. So we have to look at what can we do strategically to offset that reportable income so they don't pay any federal taxes. Because if they don't pay any federal taxes, guess what other taxes they don't pay? State.
Yeah.
So instead of them having to move to Florida or Texas or Tennessee or one of the other states, to get a 0% state tax rate, or if they go from, let's say, from California to, let's just say, Louisiana, they go from no humidity to more humidity than they can even think of, but they'll still get a raise because instead of them paying as much as a 13.3% tax rate, they would pay a flat 3% tax rate. So that's a raise, and we have to look at, why do you want to move states? Do you really want to go there, or are you only moving there for tax purposes? And build a strategic plan to realign those assets to where you're getting tax efficiency, tax freedom. And that's the key thing. That's something that we have to look at and restructure. Even if someone has a business, we have to look at, okay, how much income are you reporting a year? Are you in a high 6-figure income threshold? Are you receiving 7 to 8 figures of income or more a year? And we have to look at, okay, what ways can we help you restructure your entities, your formations to lower your taxable income, and potentially get you to zero depending on your situation. And so that's the key thing, is we have to look at where you are now and what can we do to offset those different types of reportable sources of income.